Hey, Spencer,
Hey man, what's going on?
what is debt?
What is debt? Well, essentially, debt is something that's owed by someone else. It's also what our entire economy is based on. Currency, the dollars, they're all essentially debt. They're not real money. Everything's based on debt issued by the Federal Reserve. The Federal Reserve issues Federal Reserve notes, buys Treasury bonds, which are other forms of debt having to be repaid to U.S. government. But breaking it down, a lender lends money to a borrower. They borrow money. The borrower pays interest on that money and has to repay it at some later date.
Okay, why should you use debt? Why can't I just pay for it up front?
Well, it depends on what we're talking about. If it's, if you're buying a car, maybe it does make sense to buy it with cash versus, using debt. It depends if we're talking about buying assets or buying liabilities. If you're buying an asset that's going to be producing cash flow or going to be appreciating, it makes sense to use debt. You're able to have a much smaller down payment, much less of an equity requirement. You're going to have higher returns, and there are more tax benefits for using debt versus buying something with all cash.
Okay, so how do you get the debt? How do you get a loan, especially for a multifamily project?
So it's easy and not easy at the same time. Relationships in all forms of business are important. So having good relationships help, but it's not everything. Typically, a lender, whether that's a bank, whether that's a debt fund, whether that's a government GSE like a Fannie Mae or Freddie Mac, they're going to be looking at two things. First, the project. Does the project meet their requirements? And then secondly, do the guarantors, the sponsors of the loan, do they meet their requirements? And both of those requirements are going to change depending on the bank, the institution, the type of project it is.
Okay, so you mentioned GSEs. What are these common sources of multifamily debt?
So there's a lot of different ways you can finance a multifamily property. Most investors, I believe around 48%, use some form of GSE, which is a government-sponsored enterprise. The main ones are Fannie Mae or Freddie Mac. You've probably heard of them. Housing and Urban Development, or HUD, is also, they're not a GSE, but they're a government agency that guarantees debt. So all these different groups facilitate multifamily borrowing and debt in some way. There are also just regular banks. There are thrift banks. There are CMBS loans. There are life insurance companies that issue debt. There are debt funds and a couple of other smaller sources, but those are the main forms and sources of debt for multifamily investments.
So what are some kind of the variables that go into these different kinds of loans, the things that kind of differentiate each type of loan that you might get?
Yeah, so a lot of loans have a lot in common. Again, there's a entity that's going to be issuing, funds to another entity, and that one entity has to pay back those funds on a given interest rate over a certain time and has to return that capital balance at a certain time. But the variables that kind of make up the terms of those loans can be relatively variable, in different terms and different structures work better or worse for different types of projects. But the main variables are what's the term of the loan, or how long until you actually have to pay back the balance of that loan. And then how long that loan's going to be amortized over. So if you're stretching out all of your principal payments, is it going to be stretched out over a 15-year period, like a 15-year mortgage, a 25-year period, which a lot of commercial mortgages are based off of, or 30 years, which Fannie Mae and Freddie Mac typically base their amortization schedules. But HUD has a 35-year amortization schedule. So it really kind of depends. There's also the interest rate. Different lenders have different interest rates on their loans. A lot of times it can be negotiated to a certain degree. They're typically based on a base rate like the 10-year Treasury or some kind of other, larger, indexed rate. Used to be LIBOR. LIBOR is being phased out for SOFR. And then a spread or a difference that the bank's going to make money off of that base rate. So, LIBOR may be trading at right now like 0.14% interest the bank might want to make 2.5 or 3% interest of spread between that LIBOR underlying benchmark rate and what they're actually going to be charging and what the lender is going to be paying on that mortgage itself. There's other variables such as recourse or non-recourse. A recourse loan, typically the bank will be able to go after the guarantors personally if there's a default or if the property goes into foreclosure. Non-recourse typically means that the recourse is limited to that asset itself, although there are carve-outs and certain provisions of non-recourse loans that turn them into recourse loans. And then other variables such as whether you can be paying any kind of mortgage insurance like MIP, or whether the loan is going to be an interest-only loan for a certain period of time where you're only having to pay the interest that's due, or a fully amortizing loan without interest only where you're paying interest and paying some of the principal back on that loan.
So what does it mean to amortize something?
So when you're amortizing, you're essentially just paying off the loan balance.
Okay.
And so if you have an interest rate of 4% on a $100 loan, you're paying 4% a year. But if you're amortizing, you're taking that balance of the loan that call it $100. You're paying a little bit of that back.
Paying like $5 instead of $4.
Yeah.
Okay.
Yeah.
One more bonus question. I hear a lot about bridge to HUD or bridge to this, bridge to that. What is a bridge loan?
Yeah, so a bridge loan is a financing tool. It's similar to a construction loan. They're often used when either the asset is not ready to put permanent financing in place. So a lot of times that can mean that the property isn't stabilized yet. A lot of lenders, especially Fannie Mae and Freddie Mac, they won't lend on a project until it's stabilized, which they typically define as 90% occupied. So let's say you're buying a more distressed property, it's 70% occupied, you're gonna fix it up, lease it out, get to that 90% occupancy, but you can't close on the property if you want to use financing with that agency loan. So you might go to a bank or a bridge lender that will provide you a short-term interim loan with a term of 1 to 4 years, possibly interest only, possibly amortizing, possibly recourse or non-recourse. There's a lot of different variables with bridge loans. You'll close on the property with that bridge loan, and then as soon as that property is stabilized, you'll put that permanent loan in place. Where you may have heard bridge to HUD, HUD loans are really attractive long-term financing vehicles, but they take a long time to put in place. Sometimes it can take 4 to 6 months to put the loan together, go through all the underwriting process. If you're trying to purchase a property, that seller may not want to wait 4 to 6 months for you to put your loan together. So what we've done quite a few times is we've closed on the property with a bridge loan, and then in the first 6 months of the project, we'll put the HUD loan in place. And so it's allowing us to close faster, which can be a big difference, because if we're willing to pay the same price as another potential buyer would, but we're going to close in 6 months, but they can close in 3 months, the seller's going to choose the quicker close 9 times out of 10. So it allows us to close quicker. It's an easier loan to get typically. And so it just helps us when we're going to execute on a project. But it has to make sense for the deal. There are additional costs with bridge loans, and there's different costs and fees associated with all the different kinds of financing options.